Hello, welcome to Know Your Options. Every 2 weeks on Wednesday, we dive deep into the world of options trading. We explore the fundamentals of puts and calls. We look at how you can effectively incorporate options as an investing tool to maximize your returns and manage risk. You can call us with your questions, toll free, 1-855-326-6266, or email us at knowyouroptions@bnnbloomberg.ca. Our guest, as ever, Chris Tom, CEO, Portfolio Manager at Moat Financial. Great to see you.
Yeah, great to be here.
So on today's show, we're going to be talking about cash-covered puts, and in every case, we're selling these options.
Right, yeah. So we know that, a put option gives the owner, the holder, the person who buys it, the right but not the obligation to sell 100 shares for a set price by a set date. So we're going to be on the other side of that trade by selling these options.
And this typically or ideally would be a stock you're happy to own, and it's cash covered because you have the money in your account to buy it, and you're happy to own it at the strike price.
Exactly. So the person who's buying a put option typically wants to take a bearish position on a stock, or they are buying insurance on an existing position. So they're looking to make money on that option by the stock going down. And so we're taking the other side of that and saying, look, if the stock goes down, we're happy to own it at that level, but we want you to pay us for taking that risk that you may be selling it to us in the future, but it's at a lower price than the stock is trading today. So we're happy.
So say a stock is trading at $100 and you sell options at $5 each with a strike of $5, and the holder ends up exercising. So you're owning the stock at 95. The strike price.
Yeah.
Plus, though, you put $5 in your jeans, so your effective purchase price is only $90.
Yeah. So I think if you sold a $95 put, that gives you $5 of downside protection before you hit that strike. Plus, you collect that $5. So if you take that $5 that you've collected off of that strike, yes, your effective purchase price is going to be $90. So you make that $5 if the stock goes down less than $5, if it stays flat, or if it goes up. So it's really a strategy where you're increasing the chances, increasing the odds that you make money. The only difference is if that stock goes to $200, you still only make $5. So it's really setting yourself up to have a more consistent program of hitting base hits. We're all about base hits.
It kind of reminds me of a limit order. You can put in a traditional limit order and say, sure, I'll buy 1,000 shares of this thing, but only if it gets to $95.
Yes. The big difference there is that if that stock never gets to $95, then you're just sitting on the sideline and waiting. This is a way for you to pick levels that you are comfortable getting long that stock and then getting paid. So if that stock never goes to 95, you still make that return. You make that $5 and you do it again and again and again. And it's really that repeat program that makes this so effective and makes it such a great tool for income-oriented investors.
That's interesting. So you can just hold. Yeah, you're interested in owning these stocks, but you're being stingy about it. And meanwhile, if they don't get down to your buy price, you just print option income.
Yeah, exactly. So where this strategy really comes into effect and where we're seeing it now, a new adoption, is people who bought GICs in 2022 that paid 5.5%, 6%. Well, they're maturing and the bank says, hey, how's 2% for you now? So then they look at the stock market and say, wow, we're trading at all-time highs. I'm going to go from risk-free to buying stocks, which is risky, right? Stocks can go down, buying that at all-time highs. So this is a way for a person who's got cash that's on the sideline and trying to get it into the equity market by easing their way in and doing it in a lower risk way. Or if you've been in the equity market and you've had this great growth over the last number of years and you're trying to take some chips off the table, but you go to put it in a bond or a GIC, and again, that 2% is just not quite the same as what you've been earning, you can take some of your equity off the table, sell some puts, and give yourself that embedded downside protection so that you can kind of stay in the game and have a chance at returns.
I guess you reckon this is a fairly low-risk strategy, though?
So it's lower risk than owning stocks.
Yes.
It's lower risk than buying stocks and selling covered calls. I would not call any of these things low risk because obviously you're in the equity market. If stocks go down a lot, you're going to go down as well, but albeit a lot less. So I'm looking back at my compliance officer talking to me early in my career, saying don't go on TV and call anything low or no risk.
Yeah.
But it's lower risk than owning stocks, which obviously a lot of people are comfortable with, and you can do it on all the high quality names that you'd put in a portfolio anyway.
I suppose, I mean, you can construct scenarios. Say the stock really collapses. We were talking about a stock trading at 100. Say some disaster is revealed, the CFO was embezzling or something. It goes down to $20. You're stuck then. You're buying it at 95.
Yeah, you're buying it at that higher price.
Yeah.
So again, in that worst case scenario, you're losing less than you would have had you just bought the stock because your purchase price is 90 instead of 95 or 100 where the stock was originally trading.
What about dividends? Are they a complicating factor here?
So when you're selling puts, if you are straddling the ex-dividend date, so say the stock goes ex-dividend next week and you sell something that is further dated than that, the amount of cash that goes in the dividend will be embedded in that option price. So you actually are collecting it just in an indirect way by selling puts on dividend-paying stocks that you straddle that ex-div date.
So I know we can't get too into the woods here, or into the weeds, but so it's a $100 stock. It's paying a $5 dividend. Well, quarterly. Let's say it's paying $5 quarterly. That'd be a very big yield, I know. But so I sell puts at 95 on this $100 stock. How does the dividend work then?
So let's just say the dividend is $5 every quarter, and the put, based on the volatility of that stock, that's $5 away from the current share price. Say it would have been $5, it'll actually trade for about 10. And versus on the same side, if you look at the $105 call, if it should have been 5, it'll trade for more like 1. Because when you pay a dividend, it's taking money out of the market cap of the business itself and paying it to shareholders. So you know that business market cap will shrink by that amount, and so that just gets embedded in there. But yeah, that's a whole other show on its own there.
Yeah. Okay, well, we're looking forward to the questions. We've been getting great questions. We always learn something on this show. Chris Tom is our guest on Know Your Options. Chris is CEO and Portfolio Manager at Mode Financial. We'll be taking your questions on options after this, 1-855-326-6266, or email Chris at knowyouroptions@bnnbloomberg.ca. We have an email from Max to kick us off. Can I get your opinion on this play? Sell Cisco, $85 strike price, covered calls from March of next year at $120, the premium. The strategy, strike price about 10% higher than the current price. Don't want it to be called away. I'm happy to receive a premium.
So that $85 strike is an interesting one because if you look at a long-term chart of Cisco, I believe back in 2000, it got to $82, and now it's trading around 76. I think it got to 80 the other day. So that $85, on a split-adjusted basis, going all the way back to the beginning of the millennium, would be an all-time high for the stock. So for this, when I first saw March come at me here, I thought, oh, wow, that's really far in the future. It's actually only 3 months.
Yep.
And so for us, if you could collect that type of premium, I'd maybe try to shorten the time frame. So maybe go to February instead of March. Then it's something that you're doing 6 times in a year instead of 4. But you're probably going to need to tighten that strike and look at, I think I was just looking here, the 82.5 call to February, you get about $1.25, and that's still an all-time high for the stock. But, always be prepared to sell that stock. If it goes up, you may have to sell it.
Okay. So, it's not a huge premium, $1.20. Why is that? The stock's not volatile enough? Or?
Yeah, I guess volatility is relatively low. I mean, it's compared to some of the other names, and, you have seen it moving higher. So option prices can come down on stocks as they move higher because there's just less fear surrounding the stock. But, But yeah, it's not a hugely volatile name.
Right, but you do get $1.20 in income right now. Yeah.
Yeah, it's 1.5% of the share price that you're not getting through a dividend. So why not? If for me, when something is at all-time high territory, that's usually when you should start thinking about letting some shares go. So.
Okay, we got a question from Jim. It's nice and topical. I sold a put on TELUS for December. Whoa, coming up rapidly, I guess. $19 is the strike price. Usually the puts I sell expire. What would you do? Buy back the put to the close, accept the put, sell out at the money 6 months from now. And maybe let's put up TELUS to see where it's trading right now. What does that last thing mean? Sell, what is that? Sell.
Covered call.
Sell a CC at the money 6 months out. Yeah.
Yeah. So this stock, I think it's trading around $17.50 right now. So if
Okay.
you've sold that $19 put, it's decision time here. If you do nothing and the stock stays here as of Friday, you will be put that stock.
Okay.
So yeah, those are all viable options here to take delivery and then sell a covered call. For us, we usually try to roll these things out. So TELUS a pretty low volatility name along with the other telcos, but you could buy that back and then sell something out, say 3 months, go out to March and collect about 40 cents. So you're going to buy this one to close. So that takes away your obligation to buy that stock as of this Friday. And then you sell one out to March for 40 cents more. So that's yours. That's your yield. That's just over 2% of that strike price over a few months. And then you wait and see what happens. Hopefully it bounces a little bit, but the stock's not too far off from that strike right now.
What roughly do we know what the option would be trading at right now if he's to buy it back?
Yeah, so if the stock, if it's at $17.50, it's $1.50 in the money. And because there's only 2 days left, you should be able to buy that thing back for like $1.52.
Okay.
The time value has basically should erode basically all the way because we're running out of time. And then you sell one further in the future that has more time, therefore more time value, and collect about $1.92. I just was looking earlier.
With a different strike price?
Same strike, same
Okay.
everything. Just your obligation to buy just gets kicked out further in the future. So the one thing you'll want to keep an eye on with this is when it goes ex-dividend, because if that quarterly dividend exceeds the amount of time value left in that option, you're likely to get assigned early. As soon as that thing goes ex-dividend, someone says, hey, I don't want this stock anymore, you can have it.
Right. And can the holder of an option exercise any time?
Yeah, anytime up until. So equity options are known as American-style options, which means they are exercisable anytime up until expiry. A lot of index options are known as European options, which are only exercisable at expiry.
At expiry. Right. But at any point, somebody can turn around and say, I'm exercising.
Yeah, if it's going to benefit them to do it early, then they will. And it usually surrounds dividends is when somebody would do it. Otherwise, they would just close out that option position.
We have an email from Greg. Greg is asking, can I have your thoughts on synthetic positions? For example, buy a call and sell a put at the same strike and same date. Tell us why you'd want to do that.
So this is something that we don't really do that often. What you're describing here, you're short the put, so you lose money if it goes down, and you're long the call, so you make money if it goes up. So it's exactly the same as just buying the stock. So here you've got two options and making it a little bit more complicated. So it's not something that we do very often. The time where you might actually incorporate this is if somebody has a position that is too much of their portfolio and it's got a huge capital gain in it. And you want to diversify away from it, but you don't want to trigger that gain. So what you can do in that instance is find another stock that you want to buy, but you're not going to raise the cash because you're not trying to trigger that gain. And you sell a call and buy a put on the stock that you own to sort of neutralize that. And then you can set up this synthetic position on another stock by buying the call, selling the put, and then now you've got exposure to that one without actually buying the stock. But I can tell we're heading into a slightly too complicated territory here, and there's no graphics to go with it. But yeah, the trade he's described of buying the call and selling the put, the outcome is identical to just buying the stock. So make your life easy.
Doesn't it depend on what the respective strike prices are, though?
If it's the same strike.
Oh, same strike. Sorry.
Yeah.
I meant to say the premiums, the respective premiums.
Yeah, but the thing is, all this stuff works out in the wash. And, if there was any kind of, free money to be had, there'd be a computer algorithm somewhere. We were talking before about how AI might be coming into this. There's people using that to try to find these opportunities to make some free money. And that arbitrage just disappears pretty quick.
And you're not hearing a lot about people using AI. I'm sure they boast about it on the forums and stuff. But,
we're not, other than maybe getting some better Excel spreadsheets, but no, nothing that I'm aware of.
So give us that again. So I hold stock A, and I've made a good have had a good gain on it, I don't want to trigger the capital gains tax. So I do this, buy the call and sell the put. So on stock A? Or
on stock A, you sell the call and buy the put.
Yeah.
So that effectively neutralizes that thing. So that's
sell the call and buy the put.
Yeah.
Yeah, okay.
And then now that, you're not trying to add leverage. What you can do with this synthetic situation would be where you're adding leverage. So you don't have any cash left in your account. You've got, $1 million worth of equities, and you want to have 1.1 million of equities, and you're using margin. So you buy the call and sell the put. That would be it. But we're not big leverage guys at Moat, so that's not something we do. But it is something that is available.
Do some people trade options on margin?
Oh, yeah. I mean, the thing with options is you can do a lot of really risky stuff, or you can use it to de-risk.
Yeah.
Right? They are a tool to build out your portfolio how you want. And so, you can do some wild and crazy stuff, but we just don't get involved in too much of that.
No, that's interesting. You're talking a lot of these strategies, you're just selling options and you're earning a premium.
Just trying to make some income for clients.
Yeah. Jason's on the line from Mississauga, Ontario. Go ahead, Jason, please.
Hi, Chris. Nice to see you. I believe you spoke about this last week, maybe. But for stocks that are range bound but are pretty volatile and choppy in that area, what kind of option strategies could I use to generate income or get some returns on that? If I know of this name.
Okay, I missed some of that, but I believe it was option strategy for stocks that are rebounding.
Range bound. So,
range bound.
Yeah.
Okay.
So for us,
okay.
I mean, if we see a pattern, we're definitely not technicians, to the nth degree. But if we see a pattern in a range that a stock is trading in, we will look to sell puts at the low end of that range, and then maybe step aside once it moves higher. A great example of that is Couche-Tard. We've been selling puts at the 70 and high 60s level for a long time, and when it rallies up into the high 70s, then we back off, and then when it gets down to the lower end of that range, then we look to sell puts, and if it goes down low enough, then we'll be buying the stock and hopefully taking it up to that higher end of that range, where then we're selling calls against the same position.
Okay, we got to take a break. We're going to give you Chris's top options trading ideas right after this. First top trading idea involves Lululemon. We've seen something of a rally in that stock. The CEO is walking the plank. The company came out with a forecast that the market liked. So you're suggesting, Chris, and these are all going to be selling cash-covered puts, these three ideas, selling a cash-covered put with a strike of 185 US, and you get about $5?
Yeah, so we'll go out to February. Stock, I think, is around 209 right now. When I priced this out, the stock was a little bit lower, so you might get a little bit less for that put now. But basically, 185 is where the stock was trading before that earnings announcement. And the stock's up about 10% or about 15% from there. And so we're saying, look, if the stock drops back to where it was pre-earnings, we think that the company is doing well and righting the ship. It's been a bit of a tough go for them this year. I think the stock's down about 45% year to date, even after this rally. But we're saying, look, if it goes back towards the lower end of that range, then we're willing to buy the stock. And if not, then we're going to generate about 3% in a couple of months. And it's on a name that we like.
Right. So it's a stock that everybody wants to buy a stock at a lower price if they can. You think it's attractive, but you'd like to get that nicer price. Yeah.
Yeah. And the options are reasonably expensive on Lululemon. So that's something that we also like, is higher implied volatility names that we're comfortable owning. And Lulu definitely fits the bill for that.
You don't get a huge amount of premium on this trade, it looks like. Selling cash-covered puts on Canadian Natural. They expire in February. $42 is the strike. Yeah,
so we're getting this again is about 2 months, and the stock's about 43 right now. This trade might look familiar because we've done this one on the show a number of times. Last time we recommended it, I think we brought in about 90 cents. The stock was trading at 45. So now it's actually gone down $2, but we make that full 90 cents. And then we're going to do it again, and this time we collect $1.15. So CNQ, it's been beaten up with the rest of the oil sector in this past week here. But, it's a name that we like. And to generate almost 3% over 2 months on a name that you like is, that's good. And if you can do it again and again and again, then that's even better.
So again, you're happy to own it at $42, and this reduces your purchase price for about $1.15 if you do get exercised.
Yeah, and then if we add that to the 90 cents we collected a couple of months ago, and if the stock stays here, then we'll just keep doing it again. And if the stock moves higher, then we'll likely adjust that strike price up with it for future trades. And if it goes down, then we own it, and it's got a decent dividend on it, and the availability to sell calls is there. So there's a very good trade.
Okay, and then finally, rocket companies. This not much of a premium here, but again, you're selling puts with a $15 strike price.
Yeah, so the stock's trading around 18 or 18.50. So this bringing in 70 cents on a $15 strike is almost 5%. So when you put that into perspective, it's actually a pretty big premium because we've got that huge downside. This, again, is a repeat trade. We've got $15 puts expiring this Friday. And so if we can collect this 70 cents, then we're happy to do that. We think that, if interest rates end up seeing some downward pressure in the U.S., you'll see more refinancing. And it looks like, if we do see a new Fed chair, then the bias will be lower on rates, which we just haven't seen that much refinancing in the U.S. over the last couple of years as rates have been a little bit higher. But they've got technology where you can pull up your phone and refinance your mortgage in less than 20 minutes and do that anytime.
Right. So they're a fintech company.
Yeah, and then they do a whole bunch of different things, but the biggest moneymaker is mortgages, and the market just needs to feel like rates might come down in the future, and you see this stock really move a lot higher.
Does this one trade off longer-term bond yields, though, the mortgages, or it varies, I know?
Yeah, I mean, this would be the 30-year bonds.
Yeah.
And so, obviously, the Fed doesn't control those. And we have seen in recent Fed rate cuts that you've actually seen longer-term rates go up. But this stock seems to be holding in well. And embedding this much downside protection is something that makes us just that much more comfortable.
Chris, thank you very much indeed.
Yeah.
Chris, Tom, we're wrapping up this edition of Know Your Options. Chris, Tom will be back in 2 weeks, Wednesdays, every second Wednesday, 3 p.m. Eastern. Thanks very much for watching. The close is next.